Apache CEO Steve Farris says his company's main business is following a cow through the cornfields and then getting fat on the scraps. Well, thanks to BP, there was no shortage of scraps for Apache to get fat on this year. And now the most valuable independent U.S. oil company seems poised for even more growth in the years ahead. He joins us right now. Steve, great to have you here on Street Smart. Let's talk about this year. It's been a big one for you guys. You bought a bunch of assets from BP this year. I'm just curious, would the company have done as well if it had not been for that BP crisis?
Well, number one, thank you very much for having us today. You know, we've been a growth company for 55 years. People buy Apache stock because we grow. We pay 50% dividends. So, and we have grown over that period of time. So there is absolutely no doubt that our base business is pretty primed to grow. Obviously, we took advantage of an opportunity, and it's going to serve us very well for a number of years to come.
Is this, I mean, you've made $11 billion in acquisitions this year, $7 billion of that coming from BP. Is this kind of a banner year for that? Do you expect similar numbers next year and in the years to come?
I don't think this is, the opportunity that we got from BP, honestly, was once in a lifetime. We took them out of three core areas, lock, stock, and barrel, and it's right in our wheelhouse in terms of where we do our business. So I'd love to find one of those opportunities every year, but I think they're not that plentiful.
Well, Steve, I mean, how much larger do you guys want to be? I mean, is there a point where the growth through acquisitions kind of starts to slow down for you guys?
Well, I'll be real honest with you. We never plan acquisitions. Our job is to grow our company for the long-term benefit of our shareholders, and we both drill wells and buy wells because the real point of Apache Corporation is to get a return to our shareholders.
Mm-hmm. I wonder, you're talking about the acquisitions that you do, and we talk about the fact that you like to get fat off the scraps. I mean, are there any other majors that you see in the kind of obviously, they're not going to be the same situation as BP, but in a situation where they're going to have to get rid of some assets that you'd like to pick up?
Well, let me tell you, we're always acquisitive, so, and we never stop looking. The fact of the matter is that we can grow pretty handsomely from here. Our production from the December of 09 to December of 010 is going to be up about 35%. Certainly, we can't grow that much in 2011, but we can grow significantly over the next several years. What
about, Mariner Energy? I mean, you just finished that acquisition, $2.7 billion, I believe, in cash and stock, and assuming $1.6 billion of debt. It's interesting because they're a deep water driller. I mean, why would you want to get into deep water drilling so soon after the BP disaster? Why would you want to get into that at all at this point in time?
Well, the Mariner acquisition fits us very well. If you look at their asset base, about 15% of their proved reserves were in the deep water. It gives us an opportunity to find a starter set. We're very large on the shelf of the Gulf of Mexico, and the deep water Gulf of Mexico is one of the premier oil exploration plays in North America and actually the world. So it gives us another way to win in the United States.
Steve, let me ask you about, though, what the White House is doing. They lifted that ban back in October in terms of deepwater drilling and off the coast of Mexico. Some companies have complained, though, that the White House is kind of dragging their feet and actually issuing new permits. What's your opinion on this, or what's your take?
Well, I think we had a catastrophic event. Certainly, the cautiousness of the administration is probably, in the industry's opinion, a little overcautious. But there is no doubt in my mind that the deepwater Gulf of Mexico provides 30% of the oil to the United States. And I think in the end, rational minds will prevail, and we'll be out there drilling deepwater wells again.
Hey, Steve, we'd be remiss not to ask you before letting you go about oil prices. They're up about 10%. We've seen a lot of commodities, oil specifically, headed higher. Where do you think we're going from here in terms of prices, let's say, over the next 6 to 12 months, and how does that impact your company?
Well, we're certainly not clairvoyant. We've been 50-50 oil and gas for years, and that's on purpose, not an accident, because we really can't predict prices. But if you look at the demand for oil across the world, whether it's China, India, the United States. The United States uses 20 million barrels a day. Frankly, the price of oil can't do anything but continue to go up. I don't know if that happens next year or the year after, but certainly the energy demand or the consumer demand for oil is not going to diminish.
How about natural gas, Steve? I mean, you have 50% of your assets there, and it's down 40% so far in the last 12 months. Can it turn around?
Well, I think what we've seen is a revolutionary change in the United States with respect to how many reserves we have in this country. Shale gas, hydraulic fracturing, and horizontal drilling have opened up territories that everyone knew the gas was there, but we couldn't get it out economically. We have over 100 years supply in this country, and that's probably a conservative estimate. I don't think you're going to see the volatility that we saw over the last 4 or 5 years in terms of gas price. But gas has got to be in the U.S. energy mix going forward. And it was nice to see President Obama here last week talk about the importance of natural gas to the United States.
All right, we're going to have to leave it on that note. Steve, thank you so much. Steve Farris, Chairman and CEO of Apache.